Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TEXTRON Inc. Annual Report. TEXTRON Inc. operates globally in various businesses and services across 6 segments. At the core of its operations are aircraft manufacturing and sales, with a focus on business jets, turboprop and piston engine aircraft, and military trainer and defense aircraft. The company also supplies helicopters, tiltrotor aircrafts, and related spare parts and services through its Bell segment. In addition to aviation, TEXTRON offers industrial solutions, including blow-molded plastic fuel tanks for hybrid vehicles, clear vision systems, and battery housing systems for electric vehicles. Its industrial segment also provides golf cars, off-road utility vehicles, powersports products, and professional turf maintenance equipment. The company's TEXTRON Systems segment is dedicated to defense and security solutions, offering unmanned aircraft systems, electronic systems and solutions, advanced marine crafts, and armored and specialty vehicles. The TEXTRON eAviation segment focuses on sustainable aviation solutions, manufacturing light aircraft and gliders with electric and combustion engines. Lastly, the finance segment provides financing services for new and pre-owned aviation aircraft and Bell helicopters, catering to customers worldwide. With a rich history dating back to 1923, TEXTRON Inc. has established itself as a leading player in various industries, from aerospace to industrial solutions. Unfortunately, I do not have access to the text that was supposed to be provided. However, I can still provide a general essay on what could cause TEXTRON Inc.'s stock price to increase in the past year. TEXTRON Inc.'s stock price has likely increased due to several factors. One possible reason is the company's strong financial performance. As a leading manufacturer of aircraft, defense systems, and industrial products, TEXTRON has consistently delivered robust revenue growth and profitability. This financial stability and growth have likely boosted investor confidence in the company, driving up its stock price. Another factor that could be contributing to the increase in TEXTRON's stock price is the growing demand for its products. The aerospace industry, in particular, has seen a surge in demand due to increased military spending and a rise in commercial air travel. As a major player in this industry, TEXTRON is well-positioned to benefit from these trends. Additionally, TEXTRON's strategic investments in emerging technologies, such as electric propulsion systems and autonomous systems, may also be contributing to its stock price growth. These innovative products have the potential to disrupt traditional markets and create new revenue streams for the company. Finally, the overall market conditions may also be playing a role in TEXTRON's stock price increase. A strong economy, low interest rates, and high investor confidence can all contribute to rising stock prices across various industries. TEXTRON Inc. maintains a market capitalization of $18 billion, broadly in line with the industry peer group. TEXTRON Inc. trades at a lower price-to-earnings ratio of 19 times and a lower price-to-book ratio of 2.21 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 57% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for TEXTRON Aviation and its subsidiaries can be summarized into several key areas. Revenue growth is primarily driven by the sales of new business jets, increased demand for turboprop aircraft, and certification of new products such as the Beechcraft Denali. Additionally, growth in military trainer and defense aircraft sales, as well as post-sale support and service for an installed base of helicopters, contribute to revenue growth. The expansion of backlog in key segments, including TEXTRON Aviation, Bell, and TEXTRON Systems, also drives revenue growth. Furthermore, the development of electric and hybrid propulsion aircraft, increased sales of Textron manufactured products through financing arrangements, and growing demand for sustainable aviation solutions all contribute to revenue growth. Government contracts, long-term contracts with the U.S. government, and changes in profit booking rates for performance obligations satisfied in prior periods also drive revenue growth. On the other hand, revenue decline is primarily driven by a decrease in aftermarket parts and services revenue, commercial helicopters, parts and services revenue, and industrial revenue. Additionally, Textron eAviation revenue decreased due to lower sales of electric and hybrid propulsion aircraft. Net income and profit margins changes. The net income of Textron Aviation increased by $128 million, or 23%, from 2024 to 2025. This increase was driven by higher revenues and segment profit. However, not all segments experienced an increase in net income. For instance, the industrial segment's net income decreased by $11 million from 2024 to 2025. Profit margins also underwent significant changes during this period. The gross margin as a percentage of manufacturing revenues increased to 17.8% in 2025, up from 2.7% decrease in 2023 and 2024. However, not all segments experienced an increase in profit margins. For example, the Bell segment's profit margin decreased from 10.3% in 2024 to 8.5% in 2025. The changes in net income and profit margins can be attributed to various factors such as government regulations, cost increases for materials and components, energy and shipping costs, and inflationary pressures. Additionally, the mix of government contracts and ability to control costs also impacted net income. Despite these challenges, Textron Aviation was able to increase its net income and improve its profit margins in 2025. The company's financial performance indicates a consistent generation of positive operating cash flow. This trend is evident across multiple pages in the report, where it is consistently stated that the company generates net cash from operating activities. Specifically, the figures for 2025 and 2024 show significant amounts of net cash provided by operating activities, totaling $1.3 billion and $1.01 billion respectively. The data presented on various pages supports this conclusion, including the operating activities section, consolidated cash flows, and net cash provided by operating activities. Furthermore, the operating cash flow summary and status sections also confirm that the company is generating positive operating cash flow for all 3 years, 2023, 2024, and 2025. In conclusion, based on the information presented in the report, it is clear that the company is indeed generating positive operating cash flow. This is a significant indicator of the company's financial health and stability, suggesting that it has sufficient funds to meet its operational needs and invest in growth opportunities. The company's debt level has shown a mixed trend over the past few years. In the manufacturing group, the debt level increased from $2,890 million in 2024 to $3,534 million in 2026, indicating a significant rise. However, when comparing the exact dates of January 3, 2026 and December 28, 2024, the difference is not as substantial, with an increase of only $644 million. On the other hand, the finance group's debt level remained relatively stable, increasing from $339 million in 2024 to $341 million in 2025. This suggests that the company's financial obligations have been managed effectively within this segment. In contrast, interest expenses have shown a significant increase over the past few years. The net interest expense rose by 30% in 2025 compared to 2024, from $97 million to $126 million. Furthermore, there was no interest expense reported in 2024, indicating that the company had no debt obligations at that time. However, in 2025, the company incurred a significant amount of interest expenses, totaling $15 million. This indicates that the company's financial situation has changed significantly over the past year, with increased debt and corresponding interest expenses. The performance of various segments and regions within the company was mixed in 2025 compared to 2024. On a positive note, the Bell segment saw an increase in revenues by 8% due to higher military aircraft and support programs revenues. Similarly, the Textron Aviation segment also experienced an 8% revenue growth driven by higher aircraft sales and aftermarket parts and services. The Textron Systems segment performed exceptionally well with a 14% increase in segment profit and a 27% rise in backlog. The industrial segment's Codex business remained flat, while the finance segment saw a significant increase of $25 million, 50%, in revenues and a 40% growth in segment profit. However, some segments and regions underperformed. The Textron Specialized Vehicles segment experienced an 18% decline in revenue, while eAviation saw a similar decrease of 18%. The industrial segment as a whole suffered a 9% drop in total revenues. Additionally, U.S. government contracts decreased by $81 million, 35%, and commercial sales declined by $48 million, 6%. Management's outlook on the company is mixed, reflecting both optimism and uncertainty. On one hand, they are focused on developing sustainable aviation solutions through research and development initiatives, which they believe will benefit multiple segments. They also expect to be awarded the LRIP phase of the MV-75 contract in late 2026 or early 2027, which will result in an unfavorable cumulative catch-up program adjustment. However, their outlook is uncertain due to various factors such as government funding, defense budget changes, and volatility in the global economy. They also acknowledge that demand for aircraft products is cyclical and difficult to forecast, and future demand may be significantly less than anticipated due to unexpected events. Despite these challenges, management expects to have sufficient cash to meet their needs based on existing balances and future cash generation. They are also optimistic about a positive outlook due to favorable adjustments on contracts, but earnings could be reduced if certain circumstances change. In the long term, the company's strategy is to offer a family of sustainable aircraft for urban air mobility, general aviation, cargo, and special mission roles. They expect to recognize 80% of their remaining performance obligations as revenue by 2027, with an additional 15% recognized through 2029. Additionally, they anticipate that the healthcare cost trend rate will gradually decline from 6.5% in 2025 and 2024 to 4.75% by 2032. Overall, management's outlook is cautious but optimistic, reflecting their commitment to developing sustainable aviation solutions while navigating uncertain market conditions. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, Textron acquired Beechcraft in 2014, expanding its capabilities and offerings. Additionally, the MV-75 program transitioned from a service-related to product-related model in Q3 2024, effectively becoming an acquisition. On the other hand, the company has also made divestitures, including the disposition of its powersports business in April 2025. This move is likely aimed at streamlining operations and focusing on core areas of growth. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $18 million in 2025 and $12 million in 2024. These payouts demonstrate the company's commitment to returning value to its investors. In addition to paying dividends, the company has also been active in buying back shares. In 2025, it spent a significant amount on share buybacks, with two different figures reported: $822 million, page 27, and $10,650,000, page 55. The discrepancy between these figures may be due to rounding or other factors. Regardless, the company's efforts to repurchase its own shares are evident. The company's share buyback activity in 2024 was even more substantial, with a reported expenditure of $1.1 billion, page 27, and $12,890,000, page 55. These large-scale purchases suggest that the company is confident in its financial position and is using its resources to strengthen its ownership structure. Overall, the company's dividend payments and share buybacks demonstrate its commitment to creating value for its shareholders. Concerns about inventory buildup or supply chain disruption are evident in the company's operations. On page 12, manufacturing inefficiencies and production delays caused by shortages of critical components raise red flags. The backlog at Textron Systems increased by $710 million in 2025, indicating a potential for inventory buildup. Furthermore, an increase in finished goods inventory by $34 million from December 28, 2024 to January 3, 2026 suggests that the company may be struggling with excess stock. Additionally, the LIFO, last in first out, inventory provision, reveals a negative trend of -$199 million in 2025, -$176 million in 2024, and -$107 million in 2023. The inventory valuation charge of $38 million recorded in cost of products sold also indicates potential issues with inventory management. Moreover, the production pause at Textron Specialized Vehicles due to soft consumer demand for powersports products further highlights concerns about supply chain disruptions. These indicators collectively suggest that the company may be facing challenges related to inventory buildup or supply chain disruption. That concludes the financial summary for Textron Inc. Feel free to comment below, and I will be happy to answer them when possible.